A lot of people are quick to pin it down to uncertainty and positioning around the debt ceiling. What is your take? Is that really a central event for equity markets?
Well, it will be. It will be definitely a central event. That's the catalyst that people are waiting for. I think that the risk is the fact that the market is sort of anticipating it relatively well. We know roughly the X date and when things need to be solved by in order to avoid chaos. And as a result of that, based on the comments that we get from the White House and from the negotiator, the market is starting to price in more or less chances of a success. And the problem is when you price in a catalyst like that ahead of time, you find yourself, especially now that the mood is or the consensus is that we're going to have a deal, you risk that once the announcement is made, you have a sell the news type of event where the catalyst is passed and now the market has to worry about something else, and there is no room left for further upside. And in the meantime, as people get more excited about the potential for a deal, you also risk to see some upsets, such as the one that we had basically yesterday and a few days before that, as the deal is not reached just yet.
Fair enough. And we were just showing a 30-day chart of the three major indices stateside, which are all higher on a 30-day chart. So to your point, it looks like a lot of that optimism is priced in. Let me ask you about the data. Yesterday, we got some strong economic data stateside, and yet equities sold off. Does that suggest that we are in a regime of strong data is bad for markets because it means that the prospect of rate cuts later this year becomes less likely?
Well, I would argue that it's also, I mean, there are a few factors here, because if it was just a function of, good data is bad for markets, you would see a significant sell-off in tech, for example, which is the sector that historically, or at least recently, has been mostly tied to the evolution of interest rates. I think it's a combination of a few factors, but there are clearly there's a repricing happening on the fixed income side, where the market has been pricing cuts toward the second half of this year. And as the incoming data shows, a recession might be on the card, but it might be delayed, and therefore pricing in those cuts may have been too optimistic in a way. So we have this repricing going on, and I think it may require some adjustment on the equity side. But to be fair, the equity market has been fairly resilient despite this repricing, which is encouraging.
Yeah. Julien, I do want to ask you, we have been talking about the prospect of a recession for so long now with respect to the U.S. economy. If it does actually happen, how much of a shock is it going to be to equity investors? What type of a pullback can we expect?
I don't think it's going to be a shock to anyone, because as you rightly pointed out, everybody expected. I think we started expecting a recession in 2019 when the U.S. curve first inverted prior to COVID, and probably it's the same recession that we've been waiting for since then. So it won't be a shock to people in the sense that it's going to happen. The key unknown at this stage is how deep a recession, if any, could be, and how protracted it could be. The consensus at this stage is for a more shallow recession, potentially short-lived, and we're probably on that side as well. It could be much pronounced than what is pricing, and this is when you could see downside scenario. But if it's the scenario that the market is already anticipating, i.e. a couple of quarters of slightly negative growth, that shouldn't be much of a shock.